combined DCF and PE multiple method, representing an 18% upside. The main reasons to support our recommendations are as follows. First, it's growth season for Plan B. Second, leading position enables future expansion. And third, there's a high potential from sports marketing. But before we delve deeper, let's begin with a brief company overview. Horizontally integrated with a diversified portfolio, Plan B's business can be categorized into two groups, out-of-home and non-out-of-home. The out-of-home category consists of 5 business segments: digital, classic, retail, transit, and airport media. In total, the out-of-home category contributes to 81% of total 2022 estimated revenue. The non-out-of-home category consists of 3 business segments: sports marketing, artist management, and online media. This contributes to 19% of total 2022 estimated revenue. We believe that moving forward, the non-out-of-home category, specifically the engagement marketing, will continue to grow. Ronald will now tell you why it's growth season for Plan B.
Hi, for most people, it is safe to say that the years of COVID are now behind us. Going outside in Bangkok, we'll see that most economic activities have now returned to pre-COVID normals. To show you the numbers, Bangkok's expressway traffic volume and MRT ridership has now exceeded 90% of pre-COVID levels. With mobility recovering rapidly, we expect out-of-home advertising to follow the same pattern. Moreover, Thailand is expected to welcome over 22 million tourists this year and 32 million in 2024. The rapid increasing number of tourists not only expects to boost the economy, but also increase demand from international luxury brands seeking to advertise in the prime tourist areas of Bangkok, which are mostly owned by Plan B. The recovery of mobility and economic activity stimulates out-of-home advertising expenditures, or simply OOH addicts, which directly benefits Plan B's core business. We forecast that out-of-home addicts will grow about 10.5% from 2022 to 2024, and 2.5% in the long term, aligned with GDP growth. During COVID years, Plan B has been aggressively increasing its media revenue generation capacity from 5 billion baht to 8.6 billion baht last year, mainly through acquisitions of competitors. In terms of utilization rates on its additional media, we believe Plan B can achieve utilization rates of over 70% by 2024, which is on par with pre-COVID levels. We believe this will push Plan B's revenue to new highs. Now, Yumi will explain how Plan B's leading market position allows for further expansion.
Plan B's 3 major acquisitions, namely Mako, Aqua and Boardway, have increased Plan B's market share from 25% in pre-COVID to 36% in 2022, making Plan B the dominant player in the industry. With the remaining market left with small players having poor locations and quality, we expect Plan B's market share to move in an increasing trend and reach 45% by 2030, given its competitive advantages of having prime locations, diverse media options, and advanced tracking technology. Last but not least, Gulatida will share on the potentials from sports marketing.
As tourism resumes, we expect the newly renovated and rebranded Ratchathani Stadium to grow. According to our forecast, the stadium will have a 51% attendance rate in 2023 and 58% attendance rate in 2024. The increased attendance will also increase sponsorships, which is the Plan B's main revenue from sports marketing. And because of that, we also expect revenue from the football rights management to grow as the national team gets to participate in international tournaments. I'll now hand over to Ronald, who will present the financial analysis.
Looking at future revenue, we forecast that Plan B's out-of-home media revenue will grow at 13% CAGR from 2022 to 2024, thanks to out-of-home media addicts recovery, revenue recognition from the increased media capacity, and utilization rates reaching pre-COVID levels. From 2025 to 2030, we forecast a 5% growth CAGR, and under the assumption that out-of-home addicts will grow at 2.5% along with GDP, and Plan B's market share to increase by 1% each year until 2030. Meanwhile, for the non-out-of-home media revenue, we forecast a 27% CAGR growth, mainly coming from the growth drivers of the Ratchathani Muay Thai Stadium and other sports marketing businesses. Meanwhile, for the longer term, 2025 to 2030, we conservatively assume around a 5% CAGR growth. Moving to discuss valuation. Valuing Plan B, we use a combined method of discounted cash flow and historical PE multiple to derive our target share price of 8.97 baht. We decided to use a combination of the two methods because we believe the DCF captures Plan B's strong cash flow generation abilities, while the PE ratio focuses more on earning sentiment that are interested by investors. Diving into our DCF valuation, we derive a DCF share price of 9.52 using a WACC of 7.5% and terminal growth rate of 3%. Our terminal growth rate is based on our assumption of long-term addicts growth of 2.5% along with GDP, and also possible new ventures Plan B could be undertaken. We also done a sensitivity analysis on our DCF valuation, assessing the impact of changing WACC and terminal growth rate on our DCF share price. On the other hand, for PE, we calculate a share price of 8.41 baht using our 2023 EPS forecast of 0.185 times a PE of 45.5. This PE is calculated from the average of 2017 to 2019, which represents pre-COVID levels, which we think will apply in the years ahead. Furthermore, we also compared the EPS growth during 2016 to 2019 and with our forecast for 2022 to 2025 for the next 3 years, which we found that the growth rate are quite similar, with the former being 24% and the latter at 28%. We believe the similarity in EPS growth rates with our forecast justifies our PE at 45.5. And now, Yumi will talk about the risks investors should consider.
We've identified a few key risks to Plan B's investment and would like to elaborate on the 3 highest ones, being first, risk of an online disruption, second, unexpected lease termination, and third, economic fluctuations. With the popularity of online media increasing, there's a risk that it will take away some of the ad spendings towards out-of-home media. Our sensitivity analysis shows that decrease in 1% in out-of-home media would reduce our target share by 4.5%. Failure to extend concessions, especially in key locations, can hamper Plan B's market share growth. We computed a slower growth of only 0.5% in our sensitivity analysis, and it shows that it would reduce our target price by 3%. And the company also goes, moving on to ESG. The company has a conservative mindset through its transition into using LED lamps and also recycling posters into valuable goods. They also take high responsibility for its...
Here is for the Q&A session.
Okay, you mentioned that one of the growth driver from reopening, one of the growth drivers from tourists, right? how much revenue it come from contribute from tourists for Plan B?
There hasn't been an official number from the company, but recently, in the company's revenue portfolio of the alcohol media, 53% comes from brands and companies. 57% comes from the brands, and 43% comes from agencies. And a lot of these brands are made up of the luxury international brands, which targets not only Thais but also international tourists. So we believe that with tourists increasing arrivals, the portion of this 57% is set to increase.
And normally, how much of luxury ad spending compared to the total ad spending?
We only have assumptions on this matter.
When you mentioned the utilization rate of 72%, and then you say that it's going to go back to the pre-COVID level, what's that implication on margin of the company? And what's the, I guess, the optimum, what's the utilization rate that Plan B would expect to be really profitable?
Okay, so before COVID, Plan B has a profit margin of around, gross margin of around 35%. And when COVID happened, more profit margins dropped to around, in the 10s to 20s. So you mean if the utilization rate
is 70%,
Yeah.
what's that mean for the profit margin?
we believe the gross profit margins will be almost on par with the pre-COVID. The reason it's not higher, given the even more capacity and economy of scales, is because they have increased depreciation in the years from acquiring all those signs. But afterwards, when those depreciation fade away, we believe the gross margin will be even higher than pre-COVID due to economy of scales, increased efficiency.
Okay. And what's the Plan B plan for acquisition in the next 3 years?
Actually, according to the company, they are not planning to make any more major acquisitions in the future. They just plan to utilize the billboards and the assets that they already have, and instead focus on the quality and increase pricing.
So on your valuation on PE multiple, you're using the historical PE 45 times as a way to value the company. Why do you think that this number is an optimal number, and what are the reasons behind using this, this level?
We believe investors often use comparison with historicals, and also because during this period there was no COVID, and we believe that COVID is already almost completely behind us, especially in the years ahead. We believe the conditions of this period and the periods ahead will be quite similar. Also, we also compared the growth rate of the EPS back in 2016 to 2019 at 24%, while we are forecasting EPS growth rate of 28% in the next 3 years. So this kind of similar magnitude of growth in both periods kind of makes the P 45.5 kind of justified.
But the CAGR growth in the future is high because of more of the low base or temporary event. While the growth in the past of 24% was based on the ordinary events. So why do you think it's still justified to use 45 times P?
Another reason that may be different from the current situation may be different is that Plan B's competitive positioning today is a lot different than back then. Now it almost dominates the market in terms of being the largest player with all the best media, all the prime locations. But back then there were quite a lot of competitors of similar size. For example, Aqua and Marco, which they also have good locations and good digital signs. Furthermore, with VGI as a major competitor. But now since Plan B has merged with VGI and Marco and Aqua have largely exited the market, the company is even in a bigger position to take over market share gradually. So maybe that can also factor in why maybe its base is now larger, but it's also in a more stable and stronger position, which justifies the high PE it was trading. We believe it should be trading at.
I have a follow-up question on the utilization rate. Why do you think the utilization rate cannot be higher than the historical when Plan B just consolidate the market by taking over Marco and Aqua?
Reason is that because Plan B has quite a lot more media now and in various locations, and we believe that it might be difficult to quickly achieve the highest utilization rate as achieved in 2018 right away. We believe that the recovery will be gradually. Right now, it is at 60%, which is an impressive recovery from the 43% in 2021. And as you can see, by 2023, the tourism hasn't still fully recovered to 40 million as in 2019. So we believe needs some time to get back to that pre-COVID conditions.
And follow up on the PE question, what is the PE for overseas or home company? And why Plan B deserve premium or discount to them?
There's quite a varying kind of PE on overseas, which are also due to some not being profitable, so they have negative, which maybe haven't recovered from COVID, or some having a quite smaller size. We don't have a slide to show what different countries have PE, but we think that the conditions in different countries are very specific. So, for example, Bangkok there's a lot more traffic, congestion, and a lot more. It's a very mega city, so it's maybe the context has a lot more opportunities for out-of-home media than some other countries. So maybe comparing directly with PE with other countries, media companies might not be suitable in our view.
So specifically in this slide, what was the driver of that 2025 EPS growth in the lower right chart?
Yeah, we have to
explain that. Yeah, quickly.
So just to for context, during 2020 and 2022, Plan B made major acquisitions of Marco, Billboard, and Aqua, which they used a lot of cash, and also which gave them a lot of assets, both in terms of physical assets, the billboard screens, and also the wide-use contracts, the rental contracts that come with those signs. And so, when these acquisitions happens during this period, the depreciation from those assets acquired, they all appear in 2023 and 2024. So which push the gross and net margins down temporarily. But however, after this period, after 2024, when the depreciation kind of fade away because all the older assets from pre-COVID period, maybe the end of useful life or salvage value, the depreciation is expected to decrease dramatically and stabilize in the long term. So in reality, if you look at the cash flow in the next slide, it's a much more representative of the actual performance, representative recovery, as the cash flow takes away the non-cash depreciation costs.
And why the cash flow 2025 actually dropped from 2024?
Because there will be less depreciation taken away. And
the cash flow doesn't consider depreciation.
How is that?